Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is Sunday, February 5th, 2023. All right, we've got a lot to cover. We are going to go over the Twomey Stock Market Report, and we're also going to go over some of our trades. And in between those two, we're going to cover fundamentally and technically what is developing in the markets, and more importantly, how it's going to affect trading not only today, but the next 3 months. This is a very important update, and I need you to spend a little bit extra time. And I want you to go to the Twomey Stock Market Report webpage. That's the number 2, mestocks.com. And there you'll find on the front page, the button for the Twomey Stock Market Report, and you can download it, save it, read it, and go back to it during the week to see how the market is developing and your trades are following the principles that we've outlined. So that should go right there to the weekly newsletter. You click on it and it'll bring up our newsletter. All right, let's get right on it. I want to start a little bit more on the technical side. I know fundamentally nothing has really changed, but we are going to cover that as well. But first off, I want to start with, let's go down here at the CBOE numbers. That's basically the Chicago Board of Exchange. It's the equity put call ratio. It gives a snapshot. You can track it daily. You can look at it weekly, monthly, and try to develop a trend. I don't use it more as a trend, as more as just an indicator of where short sellers are. That's what I'm most interested in. And Friday, it closed on the 3rd of Friday. It closed at 0.57. What is interesting, that is slightly above last week's 0.51, but the 4th week in a row that we've had limited change, 0.57, 0.51, 0.52, and 0.6. The higher the CBOE reading means the equity traders are buying what they call more puts than calls. And that suggests a bearish sentiment is building in a market. A neutral is ideal, and that neutral reading is 0.7 or lower. So a strong bullish sentiment is starting to develop since we are below that 0.7, right? And anything above that would be more bearish. What is that telling us? Well, as the market increases, we have more short sellers abandoning their positions and either staying out of the market or buying into long positions. That's very encouraging, and I'm going to go over a little bit. That's the first telltale sign, but I want to go over a little bit more of the technical data and readings that I like to follow to help back up where the market's going. All right, so first of all, I look at the advanced decline chart. They have it in a daily fashion, and when I look for towards a longer term trend, that's why I try to interpret it. So I go back, several months, and I look at how the advanced stocks are doing as opposed to declines, and that's this graph here. The red and black, red and black. As you can see, we've gone up quite a bit, and it did abate a little bit Friday. Makes sense, more declines than advances. But overall, many things have happened since the end of the year. We've crossed above what I track as the 200 EMA. We've also tracked. We've also crossed above the 50. That means there are more short-term buyers once it crosses over 50, and over the 200, that means there's more longer-term bullish behavior, right? And on top of that, the 200 has crossed above the 50, and that's called the Golden Cross. And we'll go into that a little bit more further. But the Golden Cross has now occurred. It started in the diamonds the Dow Jones back in early December. This advanced decline now has crossed positive. The SPY, S&P, and also the small caps. So that's telling us there's more breadth in the market, more people buying long positions and holding them. This week we had a 71.7% of the New York Stock Exchange, and that's what this advanced decline looks at, trading above 200 moving average. 71.7. That's tremendous. The number was 81.7 mid-July. That's the height of, the beginning or near the height of the bear market, the last bear market rally we had. Keep in mind, 2007 and 2009 recession, we saw 100% below the 200 moving average. So below, right? So what happened? Mid-July, we had near a low, and it was quite a few trading below the 200. We had the rally up to the bear market high, and then we had a subsequent pull off, and that's where the beginning of this chart stands. So what we're seeing here is a lot of buyers in the market, more advances decline, more stocks participating. And that's a pretty hard thing to do with the New York Stock Exchange because there's a lot of stocks in that NYSE computation, if you will. Now, one thing I'm concerned about is this RSI. RSI, Relative Strength Index, that's tell us if the market is short-term, overbought, or oversold. Any number, I use 65, the pundits use 70 and above. What does that mean? It means that we've got to a point where there's less buyers hanging around trying to get into the store, and there's more of them exiting the store. And that means that any slight sell-off or bad news, those buyers may quickly exit. So we have to be concerned. And the last time we were up around here was the bear market rally in August, which doesn't really show on this chart, and we subsequently went down to new lows. So, and that is of concern. So that's the dynamics that I'm looking at. Long term, we've got a nice trend developing, and we've got a lot participating in it. We look at the Relative Strength Index as another indicator. We try to use this over a period of time, several weeks, to see what overbought and oversold situation is. We've got the SPY, which is our proxy for the S&P, 63.5. It's been around that for the last 2 weeks. The diamonds, our proxy for the Dow Jones, is dropped a little bit from a high, up at 62, and now it's down at 53. Very good, as the market has seen sideways tradings for the Dow and the diamonds. We've seen the RSI abate a little bit, taking that oversold pressure off where it was up over at 62 back in mid-January. The NASDAQ, however, is 61.67. It was 68 last week. It was in the high 50s for the 2 weeks for that. That is screaming that it's getting near overbought. No surprise there, as the NASDAQ has raced up and is the quite spectacular gains year to date. Russell 2000, or the small caps, same, 69.5. That is screaming overbought, not oversold, overbought, and that means that there are going to be less buyers available. Now, RSI can stay extended for long period of times for popular stocks, Tesla, Amazon, Apple, because it's always bringing in new buyers. And people hold it for a long period of time. And you can see sometimes a higher RSI level. We saw it when we shorted bonds several times last year during the malaise in the bear market. It stayed elevated, but it didn't pull back. And if it did, it hit our short-term technical indicators and raced back up. So, but the difference is when you take a broader spectrum like the S&P or the NASDAQ or the New York NYSE, New York Stock Exchange Advanced Decline, there's a lot of stocks in that data. So it's much harder for them to show this overbought situation, right? Because there's more participating. So it's a little more risky when you get up into those numbers versus evaluating just one stock. So I pay a lot of attention, and my sense is we're going to see some pullbacks. How much and how far? We're going to go into that. So that's the Relative Strength Index. We look at our sector table as another way to give us an analysis of where we are and where things are going and where ultimately the money flows. I tend to look at a longer, year to date. Year to date obviously is since January, so we've got to exclude that. So we go back the last 6 months, and the 6 months is trend is what I'm looking at. Most of it is in green except for utilities and real estate. Surprising. And with the leader, materials, financials, industrials, and energy. Now, let's move that up to a 1 month trend. And what's happening right now, here and now. What's leading? Consumer discretionary. And that's really interesting because consumer discretionary is usually those stocks outperform during economic expansion because of automobiles and all those type of big heavy items. They also underperform during contractions. So to see this move forward the last 20 to 30 days is very, very encouraging. With the last 6 months, it's moved all the way up to 6.89, which is just fabulous. We've got information, communication services, real estate materials, kind of, I've got this sorted under the 1 month trend. And look at the bottom, consumer staples, healthcare and utilities, all defensive sectors, and they're the laggers. They're not growing that much. And of course, energy, we've all seen energy has taken a hit of late, and it continues to be under pressure. We're not seeing it in our utility bills because the re-rating goes in most states every 6 months with the state legislation. That I know in the Northeast that occurred like in November. Even though the price of natural gas and electricity has come drastically down on the open market and the futures market, the utilities rate increase does not change until another another 6 months out from November. So everybody's paying much higher rates than what actually is costing. So the utilities are making up all that money that they lost when rates were low last year, yet energy prices raced up. So we've got that lag. There you go. That's the sector table. We are invested basically mirroring as much as possible the sector table, and we'll take it from there. All right, so what is that all telling us, right? I want to go up a little bit further here and kind of go to the beginning of our market report. This week we definitely saw a couple of things. We weathered the Fed increase of 0.25. Meta came out with stellar performances and really pushed the NASDAQ up just to get hit with terrible earnings for Apple, Amazon, Google, even outside of that space, Starbucks and Ford. But the market took under pressure, especially in NASDAQ, but then rebounded. The only thing that did take a hit for the market on Friday was this job markets report. And that was just, first of all, how can this prediction be so far off? I don't know, but that's what I'm asking. But it came in at 517,000 versus 187,000 for creating a lower unemployment, or a drop from 3.5 down to 3.4%. So the January non-farm payrolls came out, more than double of what was estimated. I mean, I don't know how this happens, but it does, I guess. So that ignited fears that the Fed's going to continue to raise rates. We know they have another one on the dockets, albeit it might be 0.25. But more importantly, and this is what has not been factored into the market as of yet, the inflation is, as long as unemployment stays low, the cost of doing business is going to remain high. And what's going to happen is that as long as people have jobs, they're going to, they have to survive. They're going to buy goods and services, albeit at a lower rate. They're also, dipping into savings to help pay for these inflated costs, which is really and adding to their credit card bills, which is adding a lot of pressure long term. But overall, the Fed, not only is it going to raise its rates, even if they abate after that or stop raising them, what's going to happen? They're going to have to keep them elevated for a longer period of time than all has been predicting. Everybody's, you've heard it. I don't have to explain it here. You've heard all the chatter that the Fed's gone too far, too fast, and they're going to have to pull back sometime in 2023 because we're going to hit some type of recession. You know what? The Twomey stock market report here, we have a different premise, and we're going to go over that a little bit later. But basically, the Fed's going to have to keep these rates high for quite some time, and that means the cost of borrowing, doing business is going to remain higher. Companies are going to have to pass it on all along, all down the line, and how that affects the consumer: less spending on major items, less investing for the average consumer, and what's going to happen to savings? They're going to continue to reduce. That is a recipe for disaster. So is employment a predictor or a lagger? Some analysts believe employment peaks several months before economic reversals and any subsequent market downturn. Before any major downturn, hiring drops off the cliff. We all know that. We've all seen that. And actually, hiring is the first to come back after a recession. So we have yet to see anything occur on a major drop-off in hiring. Sure, the high-tech sector and some of these online, where the cost-cutting has occurred, i.e. Meta cut costs quite a bit, laid off early. That's helped their bottom line. And of course, everybody's predicting less growth in sales, and that, it's easier to meet lower expectations, right? But Alphabet or Google, Amazon, Ford, and all, what was the other one? All have not. They are starting, not Ford, but Apple, Amazon, and Google did start laying off, just not fast enough to affect their reduced numbers. And big companies like that to really miss is surprising, quite frankly. Ford, on the other hand, I did a lot of research and listened to what they were saying in their earnings and their report. And basically what they're saying is that, they're changing their model. They have this move to EVs. It is costing more, all kinds of issues there. But overall, less selling, more cost, supply issues with chips and everything else in the supply chain. But that should be abating, and we've got statistics to show that. So that was a little surprising. But that is rear view history. But what I was surprised, the CEO came out and said this: we're not going to necessarily fix this by just reducing labor. Very interesting. So that means bigger factors and a different change on how they're doing business needs to occur in order for them to return to a more profitable setting. Very interesting. So if we look at unemployment rate, and you can go into this Twomey stock market report and get a closer view of this, but basically the gray lines here are where recessions occurred. As you can see, the overlap of that dark reddish line is, right before any recession, unemployments are at, low. Hey, that's rocket. It doesn't take a rocket scientist to figure this out, but it's good to take a look at it and kind of put us in perspective. And what do we see? We're at very, very low unemployment levels. So what does that tell us? It probably indicates that, there is a lag factor, and it appears we have 3 to 4 months before the low unemployment meets the slowing economy. And we've got more on that also in this report. But basically, that means maybe April, May in 2023 is where we see that intersection taking place. And that means we may have a nice run up in stocks until that period of time. So we, especially without a single source event, other recessions, short term, albeit, but COVID, boom, economy just wakes up and stops, right? And all kinds of problems. That mortgage collapse, that great financial recession that we had, the last one before the COVID, that was all of a sudden, it seemed like a surprise, even though everybody was, indicating things were happening. We find out banks, mortgages and heavily mortgaged lending institutions were hitting the rocks and they were starting to go bankrupt, and they needed that solvency buyout. We all very, familiar with that. If not, you should go back at that and take a look. That's a good indicator of kind of like a Big Bang effect causing, uh, a recession or a war or something of that nature, where we see a dramatic, pullback in everybody selling stocks. We haven't quite had that. This is more of a slow roll, and that's very interesting because we've got the PM, we've got the manufacturing index, which has been, 3 months in a row. January came out that it's below 50, and it also was lower than previous months. That tells us as manufacturing slows, less inventory is going to be built, less raw materials are going to be bought, and hence eventually you're going to need less laborers and you're going to have layoffs. What was ISM had been negative for 2 months, but now has gone above 50, or came in at 55, I believe. So that's a really good sign. People are being hired into the service sector. So, if there's a rotation of workers going into, the infrastructure kind of build stimulus money, or the service sector, at least people can, get money by income, by jobs, right? So as the markets are advancing, the RSIS levels have also advanced. That's a big sentiment concern. Specifically, NASDAQ and small caps, along with the New York Stock Exchange, as we just discussed, advanced decline indicator, they're all near or at oversold levels. So Friday's pullback kind of helped alleviate some of these pressures, as we saw in our tables, right? And if the market can abate on the overbought, I didn't mean to say oversold, overbought levels, like the Dow Jones did in December, and the market kind of trades in a sideways range. We have a slight to small pullback, but hold a lot of our technical indicators, especially, the short-term selling indicators like the 50 EMA, exponential moving average, then that's a good sign. That with the breadth of stocks performing on the upper ledger of the upper side of the 200 EMA, more stocks participating, and if we can level up like the Dow Jones on any really negative situation or data or news, that's a good thing, because it gives us time to assess the market on where it may or may not go. If it goes sideways, it's going to help a lot of our trades, as we'll talk a little bit further about. And then also it gives a chance to get new entry points at a much more favorable number or data, price, and then also allows us to expand some of our investments or add. So that is a good thing. The fact that the NASDAQ raced up so much, 11% year to date since January, is of concern, because that means people went to beaten down stocks. We still saw Apple, Amazon, these are popular stocks now, really take a beating in some of their earnings. You had others like Tesla really do well. But ultimately, they're still under impact. So it may be too early to jump so heavily into these NASDAQ stocks. And they're still, even though they rose quite a bit, they're still down from, elevated levels that we started in January of 2022. So those are concerns. Our strategy is to weather any short-term sell-offs, lower our stops on value stocks to try to hold and maintain those for a longer period of time. And we'd probably choose numbers above the 50 EMA. In some cases, it would be below our entry, and others would be still above. And raise stops on our high growth positions. The logic or the reason behind this change is because we consider the trade is valid for short-term investors as long as it remains above this so-called 50 EMA. Simply put, bullish until proven otherwise. For now, I'm concerned because the PMI, economic signals, right, being below 50 3 months in a row, that's always been a sign of a recession, is on the doorstep. Accelerated jobs report, which we view as, really unemployment that low, it's great, but as our graph showed earlier, it may be is it a lagger or a predictor, these low unemployment numbers? If it's a predictor, we've got 3 months before we start seeing some real issues, okay? So that's what we have to worry about. And we know the consumer is feeling pain. The average family's lost 6,000 in annual purchasing power under current strategies. Prices have risen much faster than wages. High interest rates have caused all kinds of borrowing cost issues and raised that by 1,400 to the average family. So the average family effectively is it's costing them $7,400 in their annual budget that they weren't spending previously. That's a lot of money. And also we're seeing this low unemployment. People are coming back from they say, oh, these people in COVID, were collecting or had COVID stimulus money, so they weren't going to take, these tough, low-paying jobs. And, can you blame them? I mean, some of these jobs are just abysmal. You got to go to the dentist and they dock your pay because you don't have paid, you don't have either leave or, your benefits of the package of the company doesn't include for personal time. I mean, they're just, at some point you have to look the other way and say, yeah, go to the dentist. Yeah, go get your car fixed. I mean, it is what it is. But, and they're drug testing these people. Marijuana in most states are legal. They're just making it so hard for workers to go out and earn a living sometimes. It's a cause of a concern. But they're returning to work. In addition to that, people who took what they termed early retirement because they said, the heck with it, I'm not going to go back. I'm near retirement age. I got enough saved. My house is worth a bundle. I'm either going to downsize. Those folks are now returning to work. So when we have low unemployment, they say, oh, we can't hire anybody. Well, you got to take a look at why you can't hire people because they're out there. So these people are coming back to work. And in addition to these fully retired people, they need to go back to work because their retirement savings are not making ends meet. So some of these wage earners have to, if there's spouses involved, both spouses are, working, and some got second or part-time jobs to help things. Inflation is insidious, and we've hit that. So anyways, that's the concern we have. How does it affect our trading principles and where we are? We want to talk a little bit further about. And we look at the Twomey investment principles. We look at the overall trend 6 months to a year. We look at the macroeconomics, the performance of economies, changes in economic output, inflation, interest, exchange rates, foreign exchange rates, the balance of payment. Is there a war? Is there threat of war? Is there some type of, malaise that's causing the market to either go up or down? Environmental influences, that's where we shift into the fiscal policy, government spending, taxation, and again, more of the global concerns of where is the money flowing, right? And then we look at the advanced decline in RSI, which you already covered. That kind of determines short-term trade trends and where the money's flowing, okay? So we look at the S&P. We use that as our proxy for overall trend. Some people use others, but I like to use the SPY because it has a breadth of stocks. And, if we go back to January 2022, you can see, this is a big picture. So don't read too much into it other than the fact that we're in a downtrend. This upper Twomey trend track line, red, and the lower Twomey trend track line kind of hit the last 3-4 highs and the last 3-4 lows. Every time we get up to the high, we've happened to have a downturn. Now, the market doesn't know about the Twomey trend track line. This is a rear view mirror trend line, correct? So what has happened? We've broke above it, November, December, and we tested it twice and then we came back, but we never created a new low. Very promising. In addition to that, we've now broken above it and we've been up there 1, 2, 3, 4, almost a week and a half. So that's very promising and it's accelerating rapidly. In addition to that, more volume is coming into the market. So more trading volume, especially up days, that means more buyers. More buyers pushes prices up. It also, causes an overbought condition, but, it also puts buoyancy into the market. So that's improving. And if we maintain that and continue that, we could have a stellar first quarter anyways for 2023, right? So we like to look at, let's bring in some other technical indicators to kind of give us a closer picture. So we add to the stock market, and I'm going to go to my charts, my trading system here, and we're going to expand this level. We look at this black line, the 9 EMA, exponential moving average, a short-term indicator for traders. What are short-term traders doing? And we could see since, end of December, we were below the 9 EMA. We broke above it here early January 2023, and we've used that and pretty much as a springboard. Anytime prices retreat to that level, they go ahead. What's very interesting, the gap between the 9 EMA and prices right now is expanding, and that gives us more support on pullbacks. You could also conversely look at it, it's a lot, if we have a short-term pull-off, the sell-off can be fierce to get, and then you're losing quite a bit of gain there to get to the 9 EMA. We're not quite there, but that's another way to look at it. Below that, we look at the 14 exponential moving average. Same there. That tends to be even stronger support for short-term traders. Very encouraging since early January. And then below that, we have the 20. And then below that, we look at the 50 EMA. And that's really where the short-term traders reside. Anything above that the market prices above that, it's a good sign. We can see it hit that in mid-January and bounced quickly off that. And the gap between this 50 and where prices are today, close Friday, is widening. Very, very strong. And then we've got the 200 EMA in between. That is long-term traders, right? That looks back over exponential moving average, puts more weight on the most recent data versus the past data, so it's a little more real time. If you look at a simple moving average, it just is an average, right? So it's going to be a little bit different. And if you look at the moving averages, the 50 has crossed above the 200. So that's very promising. They call that the golden cross, right? So the EMAs haven't quite get there, but they should follow. So with the 200 being, we've got the short-term indicators where to, start taking short-term profits on a pullback. We've got the 200 as probably the first sign of resistance. And then the 50, if that crosses above that, that's on the EMAs extremely positive because the 50 would then become the first major line of resistance. So we've improved that gap. The MACD is way up. That's our slower oscillators. It takes time to get above zero, right? And not only has it gotten above zero, but it's got a reading of 5.88. Very strong. Stochastics are flattening out, but they've been high since early January. That's a positive sign. That's a very quick indicator. We use that to see where the next couple of days are going to go, right? I don't trade off of that. But the MACD tells me a lot because look here, when the prices were low, right? All in, when December we started pulling back from that upper Twomey trend track line, red here, what happened? The MACD crossed negative, the green and red, and then we went below zero. And that's where we got nervous because we're saying that indicating more selling ahead. And it happened to level out, and the MACD leveled out, and now we returned positive. More encouraging, we're going to go to the weekly report. The weekly report, look at the MACD. It's kind of hard to see here because of my volume indicators are so dark. But short term, it's 0.69. It is finally above zero. It has not been above zero since February of 2022. So on the weekly, it takes a lot longer time for this MACD to turn positive. And when it does, and if it holds, look at here, all of July of 2020 till the height of January 2022, and before the market really started in earnest to sell off, it was above zero. So that's quite a long trend, right? So if we are breaking above, will we, enter this longer uptrend of prices? That's encouraging. So that's all points to a trend that's in our favor, and we want to participate. Okay, so that's where we are overall on our trend analysis. Let's see. We went over stochastics. We went over the MACD. Oh, the Dow Jones. The Dow Jones, we talked about. We can go to our charts for that. We'll go over that real quick. That is also, a great example of what we were talking about. The 200 EMA and a 50 EMA. The 50 crossed above positive at the end of December, and the market, instead of racing off, which it should have told everyone that, hey, it's safe to come back into the market. It's usually a longer uptrend is going to develop. It's been going sideways. What happened was people jumped into the NASDAQ and small caps, driving them upward, right? So what do we've got? We've got a smoothing of the market in the Dow Jones. It was the safer place for investors to be if they were going to be in the market, and sometimes those stocks give a little bit better dividends and protection for downturns. And what are we seeing is kind of leveling off. That's okay, because if the NASDAQ and small caps being in this overbought scenario pull back and mimic what we saw in the Dow the last month and a half, starts trading sideways, that's terrific, because that's showing that the traders are not running for the exits. So that's our main focus, along with unemployment and along with the PMI. Those are kind of what we're watching, and that's going to be important going forward. If we look at XLK, we use that as our technical sector for the NASDAQ. What's happened there? We've got a high RSI that's abated a little bit. It was in the 70s, and now 70, almost 72, and now it's down at 68. Still elevated. In our case, the EMAs haven't crossed positive yet, but they are narrowing that gap. So that's a great sign. Can we maintain this and grow? There may be a situation where we get back up to those bear market highs in August, which would be very encouraging. That may be where we end up. I'm not in the prediction business. We kind of follow the markets, but for now, we've kind of this recent uptrend. We're basically almost 1-to-1 from the low, right? So we're in pretty good shape. The question is, will it hold, and how is it going to handle this overbought scenario? We're not, it's got a little bit more room to ride because we're not in over that 70, but we were close to it, right? IWM is the small caps, and that, just is the same view as everything else. This is kind of a busy chart, but we've had this parabolic rise up. It's gone pretty much near or close to our bear market highs. And, at that point, I think we're going to have a breather. But, do we return to lows again? I think a lot of negative sentiment would have to develop, or news. And quite frankly, unless something catastrophic happens, I don't really see that. But, anything can happen, right? Anything can happen. We have one stock, Borg-Warner, and we took it because it's part of that industrial trade, right? That, the discretionary. Come on, let's see. Come on. It's not working. Let's see. All right, we got the. Maybe we go to our trade tracker for that. Let's see, Borg-Warner, BWA. Oh, I had the wrong symbol. Let's see, now that has pulled back. It's still 12.85, but it has pulled back a little bit. All right, so I just had the wrong symbol. BWA and BWM. All right, so here, very interesting. It's back. I got to pull this way back. We'll go to the weekly. It is just about back at its January 22nd high, when the market was at its peak. Let's see. Here we are. There's January 22nd. If you can see my cursor, I'll draw a line, segment line. All right, there it was, January 2022, and here we are. That's pretty good. We are just about back in that trade. we didn't buy it at the low, but we certainly jumped in when we saw the sector change. Our sector analysis start to take place, and we were surprised, quite frankly. And it just goes to show you have to do tremendous insight and analysis beyond what we see and what we hear on the news. Headlines are one thing, but digging in underneath tells us a different story at times. So we were fortunate. We were able to jump into this trade. We're up 12.5%. Does it have more room to grow? This is the weekly chart. It'd be nice if we can get up into the low 50s. But more to tell. Okay. And here's a great example. There's the 9 EMA, quite a bit of gap. There's the 14 and the 200, the 20-day, which is in green, and then we've got the 50, and the 200 is lurking around here somewhere. This is the weekly chart. It's up here. So it's on the weekly chart hasn't crossed yet. If we look at the daily, the 200 and the 50 crossed, back in early December, end of November. And that is a good example, the golden cross and the predictor of better things to come. Yeah, we did have a little bit of sideways and pullback, but it raced off. We were able to get in on that, mostly on the factor of what we saw in our, sector analysis, and also the fact that the golden cross occurred and we're able to jump in. The whole idea is we don't buy at the bottom, we don't sell at the top, but when we get all our technical indicators favoring both short-term and long-term, we go all in and ride it as long as we can. The problem is the last quarter of 2022, the trend was waffling, it was short-term, and there was no, we're going to do better in a longer trend. In those cases of where there's what I call reactive trading, we kind of have to sit on the sidelines because we want to protect capital. Because reactive trading, where one day it's up, one day it's down, it's a surefire way of losing money. Let's see. Let us cover a few more things. So that was the indice and trends. That kind of tells us what's going on. We talked about employment and layoffs. There is a lag effect on these rate increases. We're really just starting to feel July and maybe September's rate increase when the rates were around hovering between 2.25% to 3%. We're now, up over 4.75. The effective rate is a little bit lower than that, but we're 4.5 to 4.75 with the latest 0.25. So, make the math easy. 2.5 from 3.5. It is. From 2.5 to 4.5. We've got another 2%, 2.5% of interest rates yet to absorb. So that's the lag effect. That's telling us we've got more pressure on the consumer, more pressure on companies, more pressure on cost. And as we feel the brunt of that, that's when we may see the change in that employment figure, right? And the PMI is certainly screaming that with its 3 months of contraction. That's our 4 legs of our recession tenet. Inverted yield curve. Most of 2022 and continues bearish. Well, that's going to start changing, we think. And we're going to go over that quickly, too, about yields. 2 negative quarters GDP occurred once, and then we've had 2 positive, so that has abated. PMI below 50, which is bearish. We've had 3 months in a row. The positive side of that, the ISM, which was negative, is now returned positive. So that's 50-50. Rising unemployment has not occurred. Unemployment dropped to 3.5. That's very bullish, if you will. Good employment numbers, right? You want to have people working. That's good for the economy expanding, hiring workers, but it's also inflationary. So 3 of the 4 tenets occurred in 2022. GDP rebounding, we're back to 2 out of 4. So that puts us back into the lag effect of rates, and it puts us into the effect of watching those items like employment numbers and PMI. Okay, so we've got more to come. Right now, we're going to ride the market as we can, because if it's advancing, we want to be in it. We've taking some positions that include more hopefully value type of stocks, even though some are in the energy play, that have a shorter vacillation of prices, but yet give high dividends, 7.5 all the way up to 15%. We've got some, capital and real estate type investing as well in there. So we've got a good amount. We're looking to add to another that I almost jumped in and sent out an alert this week, but I think we've got a little bit more room in price reduction before we take that. And that's another high yield, I think it's 11%. But anyways, with that said, what's the goal of these dividend plays or value plays, right? The goal is that even on a slight or downturn, the downturn doesn't exceed the dividend. And if we can maintain and hold that stock over a year, and you got a 15% dividend, even if that price drops 5%, you ultimately walk away with 10%. And if they drop 5%, the overall market probably dropped 10% or more. There's no, So therefore, you're doing much better holding those if you can. And if the market continues to go up, you're still getting that 10 or 15% on top of the increased price, albeit maybe at a slower rate than maybe a high flyer NASDAQ, but a lot less pressure, and you can sleep easier. So those we're trying to build a nice base. If we can hold those, we also have mutual funds that we've entered and are advancing nicely. And the goal is to hold those throughout any slight downturn. So we're looking for overbought areas to abate and trade sideways. And quite frankly, the overall economic data is troublesome. While the technical indicators on stocks are encouraging, 250 EMI crossing and above these trend lines, above our short and long-term indicators, the MACD, those type of things, both in breadth stocks like the S&P advanced decline, but also individual stocks like BorgWarner. So, but here at the Twomey Stock Market Report, we are starting to develop a premise that stocks will run up till April or May, then a small pullback with some type of leveling or sideways range till the remaining of 2023. It kind of sounds like stagflation. Will that occur? I'm not sure, but that is the reasoning for some of our positions in stocks versus jumping into these high flyer beaten down NASDAQs. We'll use an ETF to handle those. We can get in and out pretty good. We do have mutual funds in that area. We can get out of those. The ones we chose do not have any redemption value issues. So if we have to quickly exit those, we will. We're going to try not to. So that kind of gives us an overall meeting. We did talk a little bit of yields. I think yields are basically flattening. This is the TLT, which we are long. The yields come down as the economy softens, and that means it's less cost in borrowing. So a bond, if you buy a bond for $100 and you have to pay 5% on that's the yield, the 5%. If that same $100 bond, then 6 months later, you're only getting 3% yield, they're saying that we can sell that $100 bond a lot easier because inflation's lower, costs are lower, and then the investor, heck, we don't have to pay him as much to put his money here, right? As inflation and costs go up, these bonds have to say, hey, come over here and give us your money, and we're going to give you 6%. The higher that goes, well, that's when we trade the TBT. When it starts to drop, and you're generally in a recession, you're going to have all those dropping yields take effect. We trade the TLT. TLT tends to be a slow mover. It's the 20-year, it mimics the 20-year treasury bond or market, right? It's an ETF. It's starting to, we did have a couple of dips, but we did have some pops and dips, but it's starting to level out. That means yields are stabilizing. It does look 3 to 6 months out. If this TLT races off, that means it's going to be predicting a recession. Right now, this flattening, similar to the Dow, is, it may be an indicator of what we're going to see the next 3 to 6 months after we hit this short run-up. And that's that's what's leading to my kind of stagflation point of view. All right. So that gives us the Twomey stock market report. Go to TwomeyStocks.com. That's the number 2, MEstocks.com. There you can get our weekly newsletter. You also can go out and try to get our tracker. Just send us click on see our trade tracker. It sends us an email and we'll send you this. This is what our current trades are. We go over the instrument, or the investment. We've got bonds. We've got our index funds. Right now the TLT is flattened out. It's 2.3. We also trade the 200% version of that. You can see that's down 1.96. So that means, we're leveling off and dropping somewhat there, but we're going to watch that. We've got, the small caps running at 9.1%, but that's an overbought. We got to be concerned about that. XLK, our NASDAQ, that's up at 10 point some odd percent, mimicking where the NASDAQ's run this year at 11%. The high dividend yield of 16% for Anality Management, that's up 7.7 on top of a 15% yield. If we can hold that for the year, that's a 20 some odd percent return. I think you can take that and run to the bank. Whether that happens the next, we've got we got many months to go before we declare victory. MGM Resorts, that sector has been high in our sector table for several months now. We jumped in that's up 10% and holding. The industrial sector is we showed is way dropping and dropping. We're holding that half of our position there at 2%. We've got also iShares, and this is the European ETF. It's mimics what's happening over in Europe. That's up 3.5%. There is some value to go overseas now. Borg Warner, we already talked about. That's up at 13%. The materials sector has been strong. That's abating, and it's holding at 3% for half of our position. Half we sold off for a short, very small gain. American Pipeline Unit, that's another high dividend play, 11.5, and kind of in this energy. So we still have that, and that's running 7%. XLE, we exited that with small gains, 2% gains, 1% gains there. It's not with under pressure. There's no need to hold that sector right yet. Crescent Point Energy, which has a dividend of 6.8, that is much more volatile than the PAA. It is a energy provider, and that's down at 1.4. It's a low price stock, so we're close to our stop on that. We hope to hold that to at least get the first dividend. ILF, Latin America, that's now in the red, but it was holding pretty good. That is a material play, mostly from Latin America and South America, and all the cost of raw materials have been giving good returns. And that one does fluctuate, but we're going to try to hold that because we still feel the material sector is going to go strong because the industrials, consumer discretionary is strong, right? Advanced Micro, we jumped on those on the chip trade. Even though Intel took a beating, we're up pretty strong on that, 18% since we got in there in January 25. Let's see. We have another ETF that we recently added, Enterprise Product Partners. We're looking at this. It's got a 7.6% yield. We alerted traders last week to jump into that, and that's up 2%. That's another great way to play these dividend value stocks. Our mutual funds, we've got 3.7% on our S&P, 8.6% on our technology, and 5.5% on our small caps. And we're going to try to retain that. So again, go to the Twomey Stock Market Report website, pull down our weekly newsletter. You'll get all that information we just went over today. We're on YouTube. We also have videos on the front page with up to date. We have ways for you to, get a hold of our trade tracker. We'll email that to you. And if you want, you can sign up for trade alerts, and you can also get our video training that we have stored on our website. That's certainly our trade alerts go out to you real time when they occur. They arrive in your email. You can take your positions get in before everyone else does or sell before everyone else does, protect those profits, right? That's our goal. So that's the Twomey Stock Market Report. Welcome to our weekly analysis. Keep an eye out for more information during the week. I'm James Twomey. Enjoy your week. Thank you so much.